Behavioral economics is a field of study that combines insights from psychology and economics to understand how individuals make decisions, particularly in the context of economic and financial choices. In the realm of investments, behavioral economics explores the psychological factors that influence investor behavior, decision-making, and market outcomes. It recognizes that individuals may not always make rational or purely logical choices, as traditional economic theories often assume. Key concepts in behavioral economics related to investment include bounded rationality. Bounded rationality suggests that individuals have cognitive limitations that prevent them from fully processing all available information and making perfectly rational decisions. In the context of investments, investors may rely on heuristics, mental shortcuts, and rules of thumb rather than conducting exhaustive analysis. Loss aversion. Loss aversion refers to the tendency of individuals to feel the pain of losses more acutely than the pleasure of equivalent gains. In the investment context, this may lead investors to be more risk-averse and reluctant to sell investments at a loss, even when it might be a rational decision. Overconfidence. Overconfidence bias occurs when individuals overestimate their own abilities and knowledge. In investing, overconfident investors may trade more frequently, believe they can beat the market consistently, and take excessive risks. Herding behavior. Herding behavior describes the tendency of individuals to follow the actions of the crowd rather than making independent decisions. In investment markets, this can lead to momentum and market trends as investors follow the herd, potentially creating bubbles or panics. Anchoring. Anchoring occurs when individuals rely too heavily on the first piece of information they receive, the anchor, when making decisions. Investors may anchor their expectations or decisions based on initial market conditions or information. Framing effects. Framing effects refer to the influence of how information is presented on decision-making. The way investment information is framed can impact investor perceptions and choices, even if the underlying facts remain the same. Regret aversion. Regret aversion involves the desire to avoid feeling regret about a decision. Investors may make choices based on minimizing potential regret rather than optimizing financial outcomes. Recency bias. Recency bias occurs when individuals give more weight to recent events in their decision-making. In investing, this may lead investors to extrapolate recent market trends into the future. Behavioral biases. Various behavioral biases, such as confirmation bias, favoring information that confirms pre-existing beliefs, and availability bias, relying on readily available information, can impact investment decisions. Understanding these behavioral factors is crucial for financial professionals, investment managers, and policymakers. It helps them design investment strategies, financial products, and regulatory frameworks that consider the human aspects of decision-making. Behavioral economics has also influenced the development of robo-advisors and other technological tools that aim to provide more personalized and behaviorally informed investment advice. Investors can benefit from being aware of their own behavioral tendencies and biases, as well as those present in the broader market. Recognizing these behavioral factors may lead to more informed and disciplined investment decisions, helping investors navigate the complexities of financial markets.